What's good, everybody? So I'm super excited today. I just want to do a quick little trade recap. I have a couple things I want to run over for July 8th, 2025. The markets were super interesting today, and it brought me to want to come share a lot of different things about the market maker model, how I use it. I want to look at internal models and align them with external models and how to leave runners, when to scale into a low time frame, some stuff like how to catch continuation trades, how to test ideas on the chart, and how to even validate a tight stop loss. Then quickly I want to look over a little psychology tip and a pitfall that I myself and a lot of other traders felt today in the market. So without further ado, let's go, baby. So I'm on the charts. I just want to quickly remove all the drawings, clear up the charts. We'll do a quick little top-down analysis and see what we can get into. So like I said on Monday, I always like to define the weekly objective, right? So our weekly objective this week was just simply last week's high. So PWH, previous weekly high. And we're sitting here and we're looking how that relates to our daily and our 4-hour and all these time frames, right? We're still kind of sitting in this range where we want to see ES wants to react off of this fair value gap right here to push higher. And we want to see NQ do a similar thing, but with the order block, right? So with this order block, right? Now let's look to the 4-hour quickly to see if we can refine these at all. When I move down to refine things, I just quickly look, where is price actually reacting off of? Because I'm not guessing anything. I'm just simply looking at what zone is price reacting off of. So now I can further become more precise to see where's the most efficient zone that price wants to react off of, right? So right here, where does it just, honestly, where does it look like price reacting off of? This little fair value gap right here. Mark it in, boom, easy bread. For me, this one looks to be pretty similar. I'm just gonna mark out this little order block right here. Easy stuff, right? Scaling into the 1 hour, this is the main thing that I wanted to look over last night, or that I think last night's session kind of is important to understand, right? So the way we want to understand price is through market maker buy and sell models, right? So we'll get into this for a second. So the market maker model was validated here with the change of the state. Once we have this change of the state, we can now validate price to now have the buy curve. So we'll draw this out is right here is going to be our buy curve. We expect it to go to this high right here because our change of the state validates us to either the internal model, which could be off of this high, or it could be off of this high. And even if maybe we say we have a 4-hour change of the state, you have a 4-hour change of the state, that will validate us 100% to this high, right? So let's quickly go over the market maker buy and sell model and how I use it in my whole system and just why I use it with every second and every single trade ever, why it's so deadly. Let's go. I'm going to quickly draw this out for you. I'm going to draw out a nice little sell model right here. So sell model, simply put, is, where's the path at? Simply put is, we'll zoom out to say a daily time frame. This is what the daily looks like. Daily's pushing, it makes a fair value gap, comes back in, pushes higher. We're in a strong bullish trend, right? Our market maker buy model and sell model is going to be right within this little retrace, right? So the easy way I like to explain it is a super objective way to look at a retrace or to look at a movement in price, right? So now zooming in, what we'll likely see here is, say we zoomed into this, right? We have a fair value gap resting, right? We have a bigger time frame buy model or buy level above that we see price has been wanting to react off of, right? Now, when we see our retracement, what we usually are going to see is we're going to see some kind of equal highs left, and we're going to see some generated liquidity. And what this is doing is it's simply just price generating liquidity for itself to go take later. So price is almost like a paint roller, right? It's going to paint where it wants to go, and then it's going to come back over it to fill its tracks, right? So price generates its own liquidity to come take later. We've known this, right? So what we want to look for is our push into this level in which we expect price to react off of. We expect price to move here. Then we want to see somewhat of an internal manipulation right here where price is going to take this low. And the best thing to see here is an SMT. We want to see an SMT here. That validates price and lets us know that smart money is now in the market. And this SMT here is only valid. It's only valid here because it is a point in which we expect to see price reject or react off of something. If we had an SMT, say right up here, With this one, I'm not going to be like, okay, it's time to go, it's time to go. I'm not going to think that the market's going to move right here because we're not at a point in which we expect price to react off. So this little SMT doesn't even matter for me. Okay, next we want to see price push past this with displacement, making its change in the state of delivery right here. We want to see this run through with displacement, preferably to have an inverse for value gap right here, something here to show market pressure pushing downwards and then overwhelming market pressure, destroying that with more market pressure, right? So fair value gaps in a way are a sense of market pressure, right? We see these get ran through. Next, what we want to see in efficient price action is we want to see our buy level here get hit, right? We want to see pretty much a retrace to tap this order block or the change of state order for value gap, whatever you like to enter on. And then we want to see price just push after that. We want to see price just push, right? And then we can expect to see price eventually go hit our external buy level, right? So this right here is the internal model. Now, if you zoom out, what we're going to see is usually some sort of the same exact pattern just happening on a bigger time frame. Same exact pattern. Look, we have our manipulation leg, change the state with displacement, a little bit of movement, push, and then we have our external model or external thing right here. So look at this. We have a bigger time frame buy and sell and buy model, right? This would be the sell side of the curve. This would be the buy side of the curve. We have that on this bigger time frame, and zooming in, we have the same exact thing. This is how we align external and internal model. Next thing I want to look at is, let's zoom in even further. Say this is on a bit of a, say this is a 15-minute time frame, right? Say this is like a 4-hour imbalance. Here, I'll write this in really fast. Say this is a 4-hour imbalance, and say we're looking at a 15-minute time frame right now. What we want to do is we want to zoom in and we want to check something out. We're on a 15-minute time frame. We tap into a 15-minute fair value gap. Now we zoom in even further. Zooming in time frames even further. Say now we're on a 1-minute time frame or something like that. 1-minute time frame is going to show us this. Let me zoom out one more time. 1-minute time frame will show us this. It will show us the exact same market maker buy and sell model that we see on the bigger time frame, and on this time frame now we're going to see it once more. So pretty much what you're likely to see here is, like I said, the same exact thing. Some equal highs, some generated liquidity. We're going to see a bit of a tap in, a manipulation leg, displacement out. So now look, where did we take the trade? Because you're interested in the theory, but you're also interested in, okay, where do I take my trade? You can take the trade on this external model. You can simply set it up like this. You can say, okay, I want to add this change, boom, boom, right? But what if this has lower confirmation and it has a bigger safety net? So you have more risk on the table and you're not as efficient. You're not really a market sniper here because look at your risk reward and you're not really timing the market perfectly, right? So the way I like to take the trade, which is, in my opinion, safer, we put less risk on the table and we get more confirmation, which if you're someone who always loves confirmation, which is me, I never want to guess or put myself in a low probability position within the market. This is what you want to do. So we want to zoom in and we want to check out how, looking at this model right here, where do we enter? Well, it's the same exact thing. We buy in here and we take it to this. Now this is your first take profit. We already have a good risk reward on this. So how do we now leave this for crazy runner? Well, we have to understand that if we're trading here, number one, we take our first profit here and then we have a long way to go. So we expect price to continue. You can put partials at all these highs or you can just leave a crazy runner to here. Once again, this is an ideal situation. You're not going to be getting 13R every single day just by doing this, right? But by doing this and by price, this is the way I like to think about it. If price hits this level right here and pushes past with displacement like it does here, now what we've just created is an order block. And when we're within this buy model, we expect price to use these order blocks as support, right? So understand, if price pushes that with displacement, the way I like to think about it with the exact wording is this validates now. It now validates for us to have a runner. So if we push past, we now validate a runner. So now we can leave this if we do have this internal model playing out. And if it doesn't play out, say it doesn't play out, we're out of the trade early, we have low risk. Say it does play out, maybe it just sweeps this liquidity and then stops us out. We're most likely getting out of break even and there's no problem about it. Understand this too. If we did the same exact thing we just did here, but we took it here, now having this as our take profit, this getting hit with displacement now is the change in the state, which validates the model as a go. The change in the state validates the market maker model as a go. And I'm getting really in depth here, but it's really for great reason. If we make displacement past the change of the state, that validates our change of the state, which validates our whole model. So if we hit this take profit with displacement, we've now validated our runner, which that is how we snipe the market. That's how we get crazy reward. Final thing I want to go over, I'll just go over this quickly, is the market maker model. Like, this is super ideal and objective, right? What we could see happen, which is what happens a lot, is we could see the market pump initially, maybe come back down, tap to change the state, make a little bit of movement, give us some consolidation, come back down, sweep this, and then go. This is what we call a turtle soup. This is pretty much like an option select, in my opinion, because this gives us two options. This does not have to happen, but if it happens, it gives us an option to enter in again. It gives us an opportunity to enter in again. Once again, this right here is an internal model. You can trade, which is the way I like to do it, and then just leave that for a runner to the external high up here. Understand this though. Say we missed our entry here. Say maybe we didn't have confidence with it. We didn't have this. We wanted maybe an extra SMT. We didn't have all this, right? Say we hit our turtle soup with or without an SMT. What we can do is just zoom in and take the exact same model once again. It's the exact same thing. It's over and over and over. We just need the change in the state and we validate our market maker buy model. It's so simple. It's really so simple. But if we view the market through this, we gain clarity. We truly just gain clarity. If we have the manipulation, potential SMT, change of the state with the fair value gap and displacement, there's really nothing more that you need. The inverse value gap is great, but we don't need it. This is how I view the market, and this is how, by aligning the models, that we can snipe the market. You get crazy rewards. And this is how I took every single trade I took today. And if you view the market through this, you gain such simplistic clarity. So let's actually get into the trades today. Okay, so now that we come back to this, tell me, do you look at this differently? Does this not look like exactly what we just drew out? We have our bigger time frame level, we have the external level, we have the internal level right here, and we have the change in the state of delivery validating that internal level. That is much more clear on the hourly. So in the hourly, we had our change of the state right here. And we see price tap it, react off of it, and it's expected to continue forward, right? So understand this. We come into the day, I'll pull over ES2. We come into the day and there's three words that are on my mind. There's immediately, okay, we have the market maker model. And there's, okay, we are super discorrelated and we are consolidating. Three words, market maker model, that's three. Discorrelation and consolidation. But why do these matter to me and how do they dictate my healthy market expectations for the day? Let's move in. Zoom out to the 4-hour time frame and tell me, develop a bias on ES, right? Okay, this looks bearish, maybe a little bit bullish, but for right now it looks bearish. Develop it on NQ and you'll say, okay, this looks mostly bullish. We went through this imbalance. That is your discorrelation right there. ES is struggling to get through this 4-hour imbalance while NQ has already displaced through it. That's 100% number one discorrelation. Next, say we go to a 15-minute and we just look at price. This is barcode, bro. This is barcode. We can find our model through this. And if you were to take this trade, I'll mark this out right now. If you were to take this trade, which was simply just by zooming out and taking the model, you're not sniping it, you're not being fractal or anything, this is most likely going to play out over a longer time frame. Or maybe if you took it to this high, this is most likely going to play out. Because it's the same principle, but when we zoom out to the higher time frame, we don't have to get involved in the noise, right? So zooming in though, consolidation. We're looking at a ton of consolidation on open. This is the reason that we weren't just taking an easy 1 minute long after tapping into this and targeting for external, because we see this huge consolidation. And the reason that I like to bring this up too, is consolidation is normally not a bad thing if it happens before open, right? If we see before open, we see a ton of consolidation right here. Let's quickly draw this out. We see a ton of consolidation and we're like, okay, we have resting highs, a ton of equal highs. Market opens, dumps. This is looking good to trade an AMD model. Looks like a really clean trade. But the only reason that AMD model will work out is simply because we have a higher time frame PD array. We have higher time frame context, which once again, what is this? Looks like the market maker model to me. It's just AMD. Everything is AMD and market maker models in this entire market. Like literally everything is. So we're looking to see this as AMD, but we're being speculative because the market is consolidating and we don't have a clear higher time frame bias because the market is hella discorrelated. Let's look in on open. We open the market. On the 1 minute, we immediately dump. We make a little tiny, I think it was a baby SMT at the highs for manipulation. Something like that. We immediately dump and take these lows, right? Now, everybody is saying, and everybody is thinking, okay, let's go for longs right now, boom. Now, if you look at NQ, these longs didn't work out. ES did work out. Why can we assume these longs to work out? Well, we have our London session level right here. Market open, we push to London low, and we're like, okay, dude, this looks really good. We should just go for longs now, right? The reason that NQ longs didn't work out is because of this SMT and because we had manipulation in the market. We 100% have manipulation, but because of that manipulation, we can take advantage of it, right? Now, I took this trade, but I understood that this wasn't actually the best probability trade because if we're looking, we have consolidation. We're not expecting the market to pump. But I took this trade and I took it smart because I targeted the low-hanging fruit. The very first low-hanging fruit is what I targeted. That's how you can really get out of and still take profits in a market like this, right? And while you look at 100%, this was not the biggest probability trade because we had SMT and everything looks good, but this is consolidation. This is a pump. Why did it work out? I would put it at the SMT, and then I would also put it at this 30-second where I use as my entry time frame. Was very clean, very, very clean. I waited for my inverse fair value gap, my change in the state, entered in for longs, and we targeted for this one. It was a very easy trade, very bang. Next, watch this. This is why I think today was such an interesting day of price action. Zooming out and looking at this, we know that for our market maker model on the higher time frame, we want to see a pushback on both of our indexes to either equilibrium or the change of the state, because if we want to continue this, we made our initial displacement leg. If we want to continue, we have to have a pullback before we can blast off. So by simply looking at this, what we can do is we can say, okay, I want to be short-term bearish until we can be longer-term bullish, correct? So understand, we look at this and we see, okay, we have this big SMT put in the market. Where are we? Hold on. All right, yeah. We have this big SMT put in the market with ES as our much stronger asset. And normally, if I'm going to take a short, I don't want to trade the stronger asset. But in this situation, the opportunity presented itself. We have two equal lows, a relative equal low add on top of that. We have a beautiful SMT, we have a lower draw, and we have displacement. This is the exact market maker model that we were just drawing out. We have our change of state right here. No inverse fair value gap, but we have this fair value gap it sets into. I took this on the 30-second. Once again, I thought the structure was very clean to validate that. We had inverse fair value gap on here, just a small one. We see that eventually actually get tapped back into. We see our fair value gap retap, boom, 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 boom. The way I took this trade is I don't like to wait for the fair value gap because a lot of times if the market's gonna rip, it's gonna do it fast without actually touching back into a fair value gap. So I simply just placed my entry on the change of the state, right? So I placed it about here, targeted for these lows. Very easy bread maker, very easy bread maker. And we just have to trust the model because the model's there, it's gonna play out. And 100%, this model was here too, but it's not clean, so we didn't take it. We looked at ES better because the model was much cleaner on ES. So this was the first trade. Immediately after this, we rapid fired back in because check this out. We have what individuals are assuming as 1 minute. Okay, we had our little 1 minute pump on everybody wants to take this on NQ because NQ is always cleaner. And think about the market psychology with this. We have a little 1 minute pump. We have high resistance liquidity. Then we have a dump. People see this as, okay, this is my stop rate, or this is my maybe 5 minute stop rate before we get a 5 minute or 3 minute change of the state. And they say, okay, now I'm expecting to see my change of the state. We can go now because maybe the market just wanted to take more liquidity before it actually went for the change of the state and went for the model, correct? So what individuals are looking for is to see the change of the state, either see it here, and you get that on ES. But look at the difference between when a change of the state works out to take us to a high. So for example, so why didn't this long work out, right? Why didn't this long work out? Let's look at the difference between the change of the state here and the change of the state here that actually took us to a new high. So on this change of the state, we have a very slow lethargic move. We have an inverse value gap, change of the state, whatever. But if you look, price is just simply sitting here and just kind of going back and forth and barely getting up there. This is manipulation. The market's tricking you. Look at this one. We have a low resistance move. Literally straight up candles, displacement. We can objectify that through fair value gaps. We have 2 fair value gaps put in on the way to make the change of the state. This was a great entry if you want to take this for a low-hanging fruit long or whatever. The reason that this doesn't work out is, number one, we don't have low resistance on the way. And where we see high resistance, which you can say this move is high resistance because it's very slow lethargic, we can expect to see low resistance on the other side of the market, which is why we see high resistance here and then a swift, efficient move to take this out. So what we saw was our SMT right here. And now we simply want to look at which one's going to give us the better structure. We now know smart money's in the market. We're manipulating it. We have a lower draw because we still want to see this fair value gap get touched into. So now we simply just ask, okay, what's going to give me the better draw? Or what's going to give me the better risk reward? What's more certain? How are we looking for, like, which one should I take the trade on? My data tells me, and this is another great part about having a journal and why you need a journal and understand yourself as a trader. My data tells me that I have a better win rate, everything except risk reward, because it's just not possible when I trade the weaker asset for shorts and the stronger asset for long. So it's simply the one that didn't take liquidity, right? I'm literally just taking this trade the same way I would take it any other trade. It's just the same exact model. So what I did here was I waited for this. I waited for my change of the state. We did it with relative displacement. Everything looked great. We've had a couple candles go through. These wicks were a little bit off-putting, but I still entered in. I got my entry on, I waited for this candle and then tapped right here. And stop was at this high. And then I waited for, this is my low-hanging fruit. But once again, that was just preference. I just really was not certain that we would go to this low, because understand that if the market does actually want to go for longs, it can make an SMT here. So I want to get tapped no matter what, if there was an SMT or if there wasn't an SMT. I don't really care about this little extra bit of R. Just don't care. So what I had happen here was I got tapped, I believe, on this blue candle right here. And then we had the push, an initial push. Everything's looking great. We came back up. I put my stop at break even. I got stopped at a break even. No problem. Now I continued to monitor this trade because I still had belief in it, but I didn't want to re-enter in case something happens, right? So what I did was I'm watching this trade, and once again, this is our market maker model. We talked about turtle soups earlier, right? Which is just an internal liquidity sweep, right? So we have this, we have our displacement. I'm expecting the market to pump here, but if it does give me the opportunity, you could potentially add in. So we waited. Right here, we have a turtle soup and an SMT. If you look, we had, this one didn't take liquidity, this one did. So we have a turtle soup SMT. That's a good place to look for an entry, right? So what I do is I don't just enter on the turtle soup, because if you enter, then you're going to be entering somewhere about here, and you have to place a subjective stop loss on where you think the market shouldn't return to. If you do this one, you're risking, because what if the market doesn't want to put in an SMT, it just wants to sweep the liquidity? You have to do something like this, and even then it's risky. So what I wait for is I wait for that displacement through, just get another change of the state, and I enter off this almost as if it's an order block. this is where I didn't take the entry, but I would have added to the position. I would have pyramided into the position here. You can look for an add, and then I would have moved my stop loss to this high. Now, once again, I don't want to run through all the math, but here we can keep our risk the same or even decrease it or slightly increase it. However, I believe here we would have slightly decreased our risk because we would have put the same amount on and we would have put our stop loss in take profit. So now we have this little bit of bargain equity right here that we can put back into this one, and we have guaranteed no matter what. And we pretty much double or add a ton to our reward here. So it's always a great thing to do if you have the opportunity, right? Trade plays out banger. Let's get into the final trade and understand how so far I've just literally been taking these trades off of market maker models and off of a bias, looking at where the liquidity lies, waiting for the SMT to tell me the market's ready to go now, and boom. All I'm waiting for. Okay, let's look for the final trade. This one was an interesting one, and it was literally the same exact process that I had taken the previous two trades based on. We saw a huge displacement leg right after that trade, and we saw the market come back down. I didn't take a trade here, but I was expecting to see the market continue here because it came back, it tapped the change of the state after this displacement leg. Was expecting to see the market continue. We didn't get it, however, right? So I'm simply watching, and I see this level get swept. I would like to see an external SMT here, but I didn't actually get one at all. So there's no problem with that. But yeah, no external SMT, but we did get, and I also wanted internal SMT. I did not get it. However, I took this on the 15-second. No, so yeah, but this is not one where I wanted to look and zoom in for a 15-second trade, right? Because if you look, a move higher is more likely to just be a rebalance to all of this imbalance liquidity right here, all this imbalances. A move higher is more likely to be an imbalance, and that was going to show up on the 15-second as a change in the state, going to fake me out before the real move happens, right? And that's where I want to get involved, right? So I'm waiting for the 1 minute change. 1 minute change of the state. This is now becomes a 1 minute buy model. It doesn't matter if the model doesn't get to this liquidity because I can just take a low hanging fruit. Look, we got hit right here. Beautiful. So what I did was, I believe I took this on. Yeah, yes, I took this on. I targeted these equal highs right here, and I waited for my 1 minute change of the state. It was right here. Now I wanted to look for a tap back into this to take just the 1 minute model, because 1 minute is really as much as a zoom in as you need. You don't need to zoom in any further. But what we can do is, if we really want to zoom in, we can just trade the same way that we were talking earlier about the 15-minute fair value gap. We zoom into the 1 minute, take that sniper entry. We can just do the same thing here with the 1 minute and the 15-second, or however you really want to structure it. So what I did was waited for 1 minute change of the state. I really want to see get pulled back. Nothing happened. I eventually was able to get a pullback to this imbalance. And once again, if you look, if we took this trade, this risk is horrible. Not only are we risking a lot of points here, but we have an insane wide stop loss, and look at our risk reward. Like, this is not something I would ever trade, right? So what we did, zoom into the 15-second. We were waiting for price to give us the same exact entry model it does. Taps it, and it gives us a change in the state. Now, right here could have been an entry. Right here could have been an entry, right? You could have entered on this, and it would have been perfect. However, I was blessed and able to wait until this ended up acting as an order block support. Tapped in, and we went for longs immediately. It was a super great trade. Now, I had conviction that we would push past even to these highs, so I left a runner here. But let's talk about why I had conviction, why it didn't work out. I had conviction because if we zoom out to any other time frame, most likely even probably a 2 minute is what I would look at, is we see a change in the state here, and we see a sharp displacement past all this stuff right here. So that tells me that I have conviction that we can go to this high. Now, I don't know. This is one issue about runners and about leaving the internal model to trade to the external model. You don't know if price is going to go there now, or if it's going to come stop you out, consolidate a little bit, and then push to it. But if price is going to go now, I'm putting myself in the position to take advantage of that if that does happen. And if not, my stop's at break even, so I'm in this position risk-free. I'm putting myself in a advantageous position without putting extra risk on the table. I don't know who wouldn't do that. So we wait for the push higher, right? I'm just simply waiting for the push to hit my full take profit for about a 5.38 R. So why did we not hit full take profit? I don't know. And it was because the market wanted to come back, pull back, do a little bit of movement, and then hit. I don't know why we didn't hit take profit right now. I'm not a market maker. However, what I can do is I can react and I can look at it and say, okay, price might want to rebalance. I'm not sure. However, I know that if price is going to rebalance, it's going to make a change in the state and it's going to do it with displacement, right? So what we eyed this. We see our exact entry model against us. We see the external SMT right here. We see the internal SMT right here. Now, when doing that, I have enough maturity as a trader and enough confidence in my entry model and enough confidence in my system of trading to recognize that if I see my entry model with 2 SMTs, with everything I need on my checklist against me, it's probably smart to get out of my position or reverse my position, take that trade instead. I have enough confidence in myself and in my experience in trading to recognize that. And I'm not attached to my original position and just holding it because I think it might still hit. I'm not fully sure. I'm not doing that because at that point, you are attaching this trade to you and you're giving this trade an identity of being my trade. It's my trade. It's not my trade. It's not your trade. This trade is simply a set of variables that you chose by choosing and making the input that you did on the charts. The only thing you control here is your input, right? This trade is simply just a set of variables that you put through the machine like a function in math. You put it through the machine and you see what your output is. We have a set of variables here on the chart. And when we see the set of variables happen, we put it through the function, the machine, and we see what happens, right? It's really that simple, right? So when I see my entry model against me, I'm not going to sit there and be bigoted and say, okay, but what if it just, like, it should maybe still hit because it's mine now. Let's be smart, right? So what I do is when I see this second candle come, I think it was this candle right here, when I see this with displacement, my first take profit was here. Second take profit was assuming for these highs, but I ended up hopping out the full position right here because I saw my change of the state, I saw my fair value gap, I saw my inverse fair value gap, I saw everything I needed to have another version of me take the trade against myself right now. So there's no point in sitting here holding it, right? So instead what I did is put this one here to look pretty and I hopped in the opposite side. I placed my trade right at this, change of the state, put my stop loss right here, and looked for this as my take profit. No, actually, I believe my stop loss was much tighter, and I want to talk about why I validated my stop loss being that tight. Super tight stop loss, and we banged. And this also validates us to maybe this low, right? So we could have held this position here and then just literally apply the same system. When we see price reverse on us, we see everything we need, we see SMT, boom, 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 we just hop out. And in doing that, we can bargain an extra 0.6 R. Or maybe if it was better, we could bargain more, you know what I'm saying? So this trade is literally the market maker model right here. Like all of these trades were exactly the market maker model. You have SMT, you have manipulation, you have displacement, you have a pullback, you have everything that you need to mark this as a market maker model. Understand, however, that this means nothing without context. These are everywhere in the market, but the only reason that I traded this model and not this model or this model or all these other models was because these ones had context to them. They had a bigger time frame PD array, which for me here was simply just these 1 minute equal highs that I assumed to be a point where price would react off, because we also had a 3 minute volume imbalance right about here. We also had dual SMTs. When you see external and internal SMT, this is a great aligning combination that you 100% need to look into. Last thing I want to talk about is how do we know when it's okay to set a tight stop loss? This is a figure of wordplay that I use that allows me, psychology-wise, and just putting my knowledge and my logic through to the charts to understand why and when I can set a tight stop loss. If price is going to go in the market maker model, we expect price to generate liquidity and then move efficiently. And when I say efficiently, we'll have to get into this in another video. When I say efficiently, I'm expecting price to move quickly and to do its job. So if I'm assuming price's job is to take this liquidity down here, I want price to do its job quickly. I want it to take the liquidity quickly. Where you can see after a little bit of consolidation, we do that quickly. This is efficient price. The way we can set tight stop loss is if you have to say, if price is gonna go, it's gonna go now, right? And it's not gonna come take this high. We can set this to be safe because sure, price could go ahead and do something like this where it wants to come up, make some extra structure, take this high and then come lower and boom. And yeah, sure, this trade would have worked out and on this version, we would have got stopped out. But the reason that I'm better off taking this version instead of the bigger stop loss version is because if price is going to do all of this, the model sure is not invalidated, but the model is less efficient. And I don't want to expose myself to these less efficient conditions because I have such a high standard as a trader of what my trades should be. My trades should be fast, efficient. I should be right or wrong very quickly. I should have high R, I should have this, I should have that. And I only take A+ setups. I should have such a high standard that if the market's going to move, and if this is going to be my good trade, it's going to move now and it's going to be fast, it's going to be beautiful. If it's not going to move, I want to be out of the trade. I want to be out of the trade because I don't want to sit there and I don't want to expose myself to more risk. I don't want to have to sit on the charts longer than I have to. I don't want to sit there and puff the hopium that maybe I can make money on this trade. It's not what I want to do. Tight stop losses are valid in a position where if price is going to push past that, it's not valid given your level of standards and given your level of conviction with the model. Pretty much, if price is going to go, it's going to go now. There's nothing more that price has to do to go, which is why you can expect to take those tight stop loss trades and be good even if you get stopped out. Because I'm saying if price is going to go, it's going to go now. And if this was a complete airball and price literally just retraced and then went away, I'd be happy because I had the great potential to make a lot of R. However, I didn't, and I was out quickly and I was wrong quickly. I didn't have to play with my emotions while price went like this and played around a little bit and then stopped me out. I didn't have to sit there and play with my emotions. I just got out fast. Last thing I want to talk about, how to catch continuation trades, which is what this one was. The way I like to catch continuation trades is I like to recognize what time frame is the actual model occurring on. So for here, the model for me was probably going to be a bit of a 30-second model, right? Or a 1-minute model. I'm going to take 1 minute, honestly. The model was 1 minute until these highs, I would say. And you can subjectively place the model like really wherever you want, but it's important to put it in the chart so you can view it in that way, right? The model was a 1 minute model, right? So I'm looking for a 1 minute fair value gap so I can take that sniper entry. So if it's a 15-minute model, I'm going to wait for a 15-minute fair value gap to take that sniper entry, right? Now, if it's a 1 minute model, you're most likely not going to be able to take the top of this as your take profit. Like if it was a 15-minute model where we have, here, I'll zoom out, where we have like our bigger, say this is going to be our change in the state right here. Then we have pull back. And this is maybe our fair value gap somewhere right around here. If this was a 15-minute, we could look to take a 1 minute trade like this and have that to take profit. With the 1 minute and zooming into a 15-second, you can't really do that. You can't really do that the best. So the 1 minute trade was simply just exactly as shown. We got a fair value gap, we took that tight continuation, and then we were rewarded because if price was going to go, it was going to go. The only other thing that it's very important to be aware of when taking continuation trades is this. I like to look at the entire range in which my bottom of my model is until the top of where my model ends or where my take profit should be. And I like to draw it in equilibrium. And I like to say, okay, I don't want to take trades within, I don't want to take a long within the premium of this range. I don't want to take a short within the discount of this range. So right here, what I did was risky. It was risky because we were in premium. However, you have to understand that not a lot of the time by drawing this out, are you going to see a retracement into here to then go. So if you wait for that, most of the time you're not going to get a trade. However, those trades are going to be high probability. So by doing this and taking this trade, you have to de-risk and you have to say, I recognize this is risky, you have to de-risk. And as well, another thing is that when putting this in, we see that this low right here, this wick, is perfectly aligned with equilibrium. Say if we're at this point, right, and we want to see price is currently at this point right here. We want to see price continue all the way to this high up here. If price wants to pull back to equilibrium, so we draw an exchange of this, or our standard deviation, we see if price wants to pull back to equilibrium, which it should do now because it's between 2 and 2.5, it's going to pull back and it's going to sweep this low, hit our stop loss, and then continue without us. So because of that, we have to be very wary and understand that we're in a risky trade. And understand that that's exactly what price did. It hit 2 to 2.5, it came back to 0.5, and then it continued from there and hit our external take profit. Understand, you can even frame a trade off of this. Look at how beautiful this trade was. We had our boom, boom. I don't believe we had an S&T or anything here, but we had a really nice long that would have given you really great R, change the state, everything's great. Could have had a long there from understanding that 2 to 2.5 back to equilibrium, back to the external level behavior and price. That's how you catch continuations. You have to be very mindful of that. And I think that's really all I wanted to go over in price action today. Overall, a super great day. Last thing I want to talk about quickly, I want to talk about how I mark out trades, because some of these I didn't take, but in my mind I'm taking them, or I'm putting just a small little like 1 micro on these. And the way I mark out trades is I literally just place the position to it. We say, okay, theoretically, if I did take this, how would it go? And it's not something that I'm emotionally attached to because I don't have to press a button. I just simply put it there and I watch, okay, how'd it go? I can delete it at any moment. I can change it halfway through and say, okay, maybe a better stop loss placement would have been this. And of course, it's not 100% realistic, but this is simply to build conviction, to test ideas, to do all these things that might help you in the future. So by sitting here marking out, we can gain a lot of knowledge that other people don't just by sitting here and looking at the charts all day and waiting for the setup. If you are able to control yourself emotionally while trading more actively, and not actually commit high size to risky trades and overtrade and do things, but if you're able to control yourself while actively trading like this, it is a very, very dangerous way to trade. A very, very great way to trade to make a high R, a lot of money in a short amount of time. The last thing would be psychology. This one psychology tip that was definitely within me today. When we have a day like this, where everything that we trade is an inside model, it's all internal, nothing's really the best, most concrete. Like today, look at this, zoom out. This was consolidation. We traded tons of internal models. We never looked to trade a bigger time frame push, which is 100% the higher probability model. The one that we do want to trade is that. However, when we're sitting here and looking in here, we cannot get overwhelmed by all this opportunity passing us by. And we cannot let it allow us to take bad opportunity and disguise it in our minds as good opportunity, allowing us to validate ourselves to take it and not understand that it's not really good opportunity, right? We cannot let all these trades go through our mind like, oh, brother, there's just a trade there, there's just a trade here. Okay, I'm going to take this one this time. We cannot let that happen. We have to simply just be faithful to our rules, faithful to our checklist. And we have to understand that by allowing price, or by following our habits over the long period of time, we will make incredible amounts more money than we will by taking risky trades every once in a while. It's just the truth. It is truly just the truth. Understand that and follow your habits. If the trade doesn't hit all your checklists, follow your habits. If the trade doesn't hit all the checklists, don't take it. If you feel off on conviction, practice dynamic sizing. Put lower size in and understand that following the habits day after day over the longer period of time will make you far more money than any risky, crazy, high R trade that you put in over leverage and make money on today. Over years of following great habits, you will make exponentially more money than you will today by putting on trades that are risky. Understand that and don't let the trades that are going by in the market, don't see all this opportunity in the market. Simply just look for your model. Just look for your model. Don't look at every single move and be like, oh my gosh, I could have been in that move. Oh my gosh, I could have been in that move. Just look and say, okay, yeah, you could have been in that move, but was there an entry given your entry model and given your trade model? No? Then why do you care? Your model blocks you out from taking that. You can't take that. Don't be mad at yourself. That's how you have to look at this market. And you have to say, all of this opportunity around me really is an opportunity for me because I'm not out there for money. It's opportunities to make market moves and make money off of it, but I'm not trading to make money. I'm trading to follow my habits. Really make that mental shift and your trading will explode. Thank you all for listening. I hope y'all learned some crazy stuff today, and I'm glad for that, boys. All right, I'll catch y'all later. Peace out.